The state of the US housing market is one topic that has received a lot of attention recently. A quick Google search will yield a ton of articles and commentary on how the housing market has become overheated. And right now, we're in the midst of another housing market bubble, similar to the one that preceded the beginning of the great financial crisis. The average price of a home in America recently surpassed $400,000, an increase of 20% in just a year. Prices continue to rise, and interest rates continue to rise, putting the American dream of home ownership out of reach for many people. Many people believe that a crash is just around the corner as a result of these developments. Even the Federal Reserve has stated that they're seeing signs of a brewing housing bubble. In this video, we'll look at what's going on in the US housing market and why so many people are concerned, as well as the trillion-dollar question: are we really in a bubble? Before we continue, please hit the like button and subscribe to our channel for more content like this. At today's prices, the total value of a single family home in the United States is estimated to be $43.4 trillion. This means that based on his net worth of approximately $250 billion, it would take approximately 174 Elon Musks to purchase all of the homes in the United States. The majority of Americans' net worth is comprised of their home. Housing accounts for a sizable portion of the US economy. In fact, housing accounts for approximately 15 to 18% of the US economy. This includes some large corporations such as major home builders, building material manufacturers, banks that finance homes, retailers such as Home Depot and Lowe's, appliance manufacturers, and all the way down to your local plumber, real estate agent, and the hardware store. Many individuals and businesses rely on a healthy housing market to operate. Furthermore, when home values rise, individuals in the economy benefit from what is known as the wealth effect. This is the idea that as a consumer's wealth grows, they're more likely to spend money. This means that if someone bought a home in Los Angeles, California for $300,000 10 years ago, it would now be worth $1.3 million, and that extra $1 million makes them feel pretty good. Do you think they're more likely to buy a new car or go on vacation because they have an extra $1 million in net worth? That is the wealth effect at work. I say all of this to make a point. The health of the housing market is linked to the health of the broader economy in the United States. In other words, if the housing market crashes, neither the economy nor the stock market will fare well. This is why the housing market's health is closely monitored, and when cracks appear, it can cause concern. To say anything related to the housing market has done well in recent years would be an understatement. Almost every company with a stake in the US housing market has seen record profits. D.R. Horton, the largest home building company in the United States, for example, had $27.7 billion in revenue and $4.2 billion in profit in 2021. To put that into context, 10 years ago in 2011, the company's revenue was $3.6 billion and its profit was $84 million, demonstrating how prosperous the last decade has been for housing related businesses. And it isn't just businesses that have benefited. The average homeowner may have been the most fortunate over the last decade. The long term historical return on stocks is generally thought to be around 10%. From 2010 to 2019, home prices in the United States rose steadily, but in recent years, prices for houses in America have skyrocketed. Just in the last year, the median price of a home has risen by 20%. There are some hot real estate markets where prices have risen even further. According to stats, Austin, Texas is up by 30%, Boise, Idaho is up 34%, and parts of Phoenix, Arizona are up 30%. Everyone seems to be talking about how these price increases are unsustainable in light of this new normal. Before we proceed any further, please click the like button and subscribe to our channel. Now let's return to the video. The first major driver of the rise in home prices in the United States is that there aren't simply enough homes to go around. This is the fundamental law of supply and demand. When there's more demand than available supply, prices can rise. Many home builders were badly burned during the 2008 housing market crash, and since then, not enough new housing has been built to keep up with the population growth. According to the US Census, 12.3 million new American households were formed between January 2012 and June 2021, but only 7 million new single family homes were built during that time. That means that the United States underbuilt new single family homes by more than 5 million homes during that time period. Single family home construction has been plagued by a severe labor shortage that began well before 2020 but has been exacerbated by recent events. Building material prices have risen as a result of supply chain disruptions in the last year, and as demand has risen, so have land prices. As a result, there aren't that many houses on the market that are available for purchase. Prior to the last few years, there were typically between 1 million and 1.5 million homes on the market. That figure is now less than 500,000. This means that prospective buyers will have fewer houses to bid on. As the number of houses on the market that can be purchased decreases, while the number of people looking to buy a house increases, the price rise is a natural result. It's all about supply and demand. However, the scarcity of housing is only one component of the problem. Interest rates are another factor driving up housing prices. The vast majority of people don't have enough money to pay for a house in cash. Most people need a loan to buy a house in the United States, and the standard structure is a 30-year fixed rate mortgage, in which the borrower pays a fixed amount for 30 years. Interest rates have a great impact on home affordability and ultimately house prices. Simply put, lower interest rates allow more people to purchase a home while maintaining the same monthly mortgage payment. Interest rates on a 30-year mortgage were hovering around 5% at the end of 2018. By historical standards, it's still pretty low. That average interest rate had fallen to 2.5% in January 2021. This may not appear to be much at first glance, but it has a great impact. With a 5% interest rate, a prospective home buyer can obtain a loan for $373,500 and make a monthly mortgage payment of $2,000. However, when interest rates fall to 5%, the loan amount rises to $57,500. That's an extra $134,000 a person can borrow while still paying the same amount each month. When interest rates were low, people who wanted to buy a house could simply afford to make higher offers. To use an analogy, the housing market was already on fire due to a lack of supply as a result of years of underbuilding, and adding low interest rates to the mix was akin to pouring gasoline on fire. However, it's critical to understand that the phenomenon I just described can also occur in reverse. As interest rates rise, home buyers must pay more each month in order to qualify for the same loan size. This dynamic is currently at work in the market, and it's one of the primary reasons why many people believe the housing market is in trouble. Rates on 30-year mortgages are rising at the fastest rate since 1994. The average interest rate on a 30-year mortgage was around 3% at the start of this year. That interest rate has risen to 5% in a matter of months. This is the highest mortgage rate in 10 years. The last time 30-year mortgage rates reached this level was in 2011. Mortgage rates are priced based on what is known as the 10-year Treasury, which is essentially the interest rate at which the United States government can borrow money for a period of 10 years. The yield on the 10-year Treasury is currently around 3%. This is nearly 3 times what they were a year ago. Mortgage rates are bound to rise as 10-year Treasury yields rise. These interest rates are likely to rise further. To combat the worst inflation in decades, the Fed has already signaled to the market and the economy that interest rates will be raised. What has been amazing and surprising to most people is that, despite the fact that mortgage interest rates have nearly doubled from where they were last year, there hasn't been a significant impact on prices yet. Houses continue to receive multiple offers within days of being listed, and bidding wars are still common. Many people are concerned about this. In the United States, the median pre tax household income is around $70,000. This leaves a decreasing amount of money for households to use for other expenses or to save and invest. Two things are happening here. Homeownership is becoming more out of reach for the average American family as household incomes have not grown fast enough to keep up with the cost of purchasing a home, and the housing market is becoming less stable. People who pay a larger portion of their income on their mortgage are more likely to be unable to repay their mortgage and risk losing their home to foreclosure. So, while the economy is still very strong right now, if there's a slowdown or even a recession, people who spend 40 to 50% of their after tax income on mortgage payments are likely to be the first to default. The more households that have a higher mortgage payment in relation to their income, the more potential foreclosures there are. While the housing market appears to be strong for the time being, there are some warning signs on the horizon. If interest rates rise, It will naturally have a dampening effect on home price appreciation. If the economy slows significantly, it could lead to defaults and foreclosures on people who have stretched their budget to buy a house in this crazy housing market. This may put downward pressure on prices, and having said that, I don't see prices falling drastically unless something drastic changes. So there you have it. Please do give us a like and subscribe to our channel. We'll see you in the next video.